In its recent RBI's Monetary Policy Committee, the RBI has decided to keep interest rates neutral. Yes, because of this reason, and one of the most important reason for this decision to be taken is nothing but external factors. India is one of the most important nation, especially when it comes to energy security and defense equipments. And at the same time, there is a trade war is going on when it comes to USA under the same time India. And there are final negotiations have been happened for the bilateral trade agreements, especially to counter these tariff measures. Already 25% of tariffs have been imposed by US government, and very recently another 25% of additional tariffs will be imposed as a penalty for India because we are importing Russian oil. So that is one of the major impact on Indian economy also. So let's try to decode what is the recent stance of RBI, especially when it comes to RBI's repo rate and how it will have contagious effects on total economy. So let's try to understand what is this repo rate and how RBI has managed to do its liquidity and credit supply and at the same time economic growth in Indian economy. So that is the discussion for today's class. The Reserve Bank of India has in its monetary policy committee decided to keep the repo rate unchanged at 5.50. It was from February itself. From February 2025, this repo rate has not unchanged and kept at 5.50 interest rates. Before that, it was a 6.50 with 100 basis points. The RBI has decided at 5.50. Let's try to understand what is repo rate. Repo rate is nothing but, in simple terms, interest rates. The RBI has given loans to banks for short term, but banks has to provide some collaterals, right? These collaterals will be in the form of government securities or any other securities as mentioned in RBI. So RBI has to loans to the banks has to pay interest components. This is how repo rate works. It is your quantitative tool. Under liquidity adjustment facility. So what happened if repo rate has been reduced or at the same position? Obviously, banks have enough money. When banks have enough money, obviously, the money supply in the economy is very high. When money supply is very high, obviously, people and businesses, especially, they will take loans and they will expand their businesses. So obviously, the economic growth will be stimulated during slowdown times. But one problem with this monetary policy decisions is monetary policy transmission. Nothing but whatever the decisions that have been taken by monetary policy committee, it has not been passed to the customers as easily as they decided, right? So let's look at monetary policy committee. It is nothing but a 6-member body, 3 from RBI, 3 from Government of India. It was constituted under RBI Act 1934 and later it was amended in 2006 under Finance Act 2016. And the decisions of monetary policy committee, whether increase the interest rates or decrease the interest rates, are there any reserve requirements that has to be increased or decreased, that will be decided by majority of the votes. So let's suppose if there is any tie on the situation, then obviously the RBI governor has a casting vote. Nothing but another vote will be given. And if you look at this monetary policy committee under RBI Act 1934 Finance 2016, the government of India has come up with a flexible inflation targeting framework, FITF. Flexible inflation targeting framework. Why it should be flexible? Because the country should be run, right? The economic growth needs to be understood. And at the same time, there is a problem of inflation. So while taking decisions, especially, you should keep in mind that economic growth should be supported. Whenever you have taken any decisions, whether it should be repo rate or reverse repo rate or any requirements, especially CRR or SLR components, then obviously you need to keep in a mind that your economy should be growing. That's why it should be flexible inflation targeting framework. That's why it was called as FITF. And at the same time, the FITF framework has kept a tolerable band limits. Nothing but how much your inflation should be within the limits. 4% plus or minus 2% tolerable band limits. Nothing but your inflation should be between 2 to 6%. If below 2% or above 6% was there in any case, then obviously you need to explain to the government of India what was the reason behind your high inflation rates, or let's suppose low inflation rates. High inflation rate and at the same time low inflation rate, both are very dangerous for economy. So that's why sometimes the interest rates are in Goldilocks zone. Nothing but neither too hot, neither too cold. The economy is fluctuating in a way that it should not have any negative effects and at the same time any positive effects. Nothing but in neutral stance. That's why flexible inflation targeting framework is very important. And impact on the Indian economy. How it will impact? So the first one is on banks. Banks have more liquidity and they will expand their loans. So obviously they can get their profits if businesses are going well. That is the first one. Second one, on people and business. Because repo rate is very low, the banks are providing loans at cheaper interest rates. So obviously the businesses will be boom and employment will be generated, and at the same time the economic growth will be the your common agenda. On larger note, not only you focus on this monetary policy, sometimes you should focus on your fiscal policy also. It is not related to fiscal policy. Monetary policy is completely different aspect and fiscal policy is a completely different aspect. But after 100 basis points correction, so the real-time effects of this monetary policy transmission does not seen in banking sector. Monetary policy transmission is very weak in this country. So these are the impacts on Indian economy. So let's understand the repo rate with one question. What is the most likely outcome of a decrease in the repo rate? So whether increase or decrease, these are the only two keywords that you need to focus in your mind when it comes to prelims examination. Increase in inflation due to high money supply, higher interest rates on retail loans, reduction in economic growth due to decreased liquidity, increase in the cost of borrowing for commercial banks. So when repo rate is decreased, banks have more money, right? In simple words, when banks have more money to lend, then obviously the people have more money to at their disposal. Means the purchasing power is very high. Whenever the people have plenty of money in their hands, then obviously they will demand goods and services. Obviously, the inflation will be high. So when repo rate is decreased, obviously you are promoting inflation in the economy. That is also good for sometimes. Inflation has different types of components: galloping inflation, hyperinflation, trotting inflation. These are different types of inflation, and to some extent inflation is very good for economy to one point of time. After that it is not good, whether it has to be taken decisions by government of India itself or monetary authority under RBI. So the first one is increase in inflation due to higher money supply. Second one, higher interest rates on retail loans. So when loans are given at a cheaper interest rates, the second statement, it seems to be incorrect. Reduction in economic growth due to decreased liquidity. Here, actually, the liquidity is increasing because the banks have money, and from banks to people or businesses, money is flowing on a cheaper interest rates. This is also incorrect. Increase in the cost of borrowing for commercial banks. No. The cost of borrowings from RBI has been reduced. That is the definition and meaning of repo rate itself. This is also incorrect. So the first one is a correct statement, right? So that is the discussion for recent repo rates unchanged at 5.50, and what were the expectations on Indian economy. The RBI governor Sanjay Malhotra has recently claimed that the world is facing turmoil, especially weaponization of economic trade, whether it should be from USA, whether it should be from Russia or from China. So obviously we are looking for the better results. That's why we have kept repo rate at 5.50. So that is the discussion for repo rate and recent RBI decisions on larger Indian economy context. Thank you for watching class. Have a nice day.